Welcome to Module 2 and of Understanding Financial Statements. In this session, we'll go beyond stock prices and market trends and look into the real numbers that drive every company's value. To make smart investment decisions, we must first understand what a company earns, what it owns, what it owes, and how it manages its cash. This module will help you learn how to interpret financial statements, identify key indicators of company health, and spot red flags that investors should never ignore. So let's begin with section 1 of Introduction to Financial Statements. Every company prepares three financial reports: the income statement, the balance sheet, and the cash flow statement. Together, these three form the financial DNA of a company, each one showing a different perspective of performance. The income statement tells you what the company earned over a period, for example, 3 months or 12 months. The balance sheet shows what the company owns and owes at a given period of time. The cash flow statement reveals where the company's money is actually going. For example, in OGDC, the money is getting stuck in receivables and is not turning into actual cash that the company can use for exploration and creating shareholder value. As an investor, learning to read these statements helps you understand whether a company is truly creating value or simply looking profitable on the surface. Let's start with the income statement, sometimes called the profit and loss statement. It tracks a company's performance over a specified period, often a quarter or a year. It begins with revenue, the total income earned from sales, then subtracts expenses like operating costs, interest, and taxes to show net income or profit. A few key metrics to focus on. Gross profit. Gross profit is calculated after deducting cost of sales from actual sales, which shows how efficiently the company produces its goods. Operating profit is calculated after deducting other operating expenses from gross profit, giving us operating profit and reflects the core business performance. Net profit, which is calculated after deducting interest cost, finance cost, and taxation, reveals how much remains after all costs. By studying trends in profit margin, we can judge if a business is becoming more efficient or losing control of its cost over time. Now let's move on to the balance sheet. The balance sheet is a snapshot of the company's financial position at a single point in time. It follows the fundamental formula assets equals to liabilities plus equity. This means that everything a company owns, its assets, is financed either through borrowed money, liabilities for example, through a loan from a bank, or shareholder funds, equity, also known as capital that owners of the company invest into the business itself. Investors look at the balance sheet to evaluate financial statements and leverage. For example, a company that relies too much on debt may face trouble when interest rates rise, like recently in the boom bust cycle that Pakistan faced during the year 2021 and 2022, causing interest rates to skyrocket to a level of 22%. But a company that maintains a healthy balance sheet between debt and equity can survive downturns and invest for growth. For example, Kohat Cement had little to no debt during the downturn cycle of 22% high interest rates that Pakistan faced during 2022 and 2023. Strong companies tend to have solid asset bases, manageable liabilities, and growing shareholder equity. Moving on, the cash flow statement. The cash flow statement is often underestimated but is incredibly powerful. A company can report profits on paper like OGDC but still be struggling with cash. And this statement reveals the truth. It tracks inflows and outflows of actual cash and is divided into three parts: operating activities, the day to day business operations, Investing activities, spending on long-term assets like plants or acquisitions. Financing activities of raising capital or paying debt and dividends. Positive operating cash flow means the business is generating cash internally and a key sign of financial strength. Remember, profits are opinions, but cash is fact. Once you understand these statements, you can start comparing companies using financial ratios. Let's go over main categories. Profitability ratios measure how effectively a company turns sales into profit. Example, return on equity, return on assets, and gross profit margin. Liquidity ratios show how easily a company can meet short-term obligations. Example, current ratio and quick ratio. Leverage ratios indicate how much debt a company uses to finance operations. Example, debt to equity and interest coverage ratio. Efficiency ratios measure how well the company uses assets, examples inventory turnover and asset turnover. These ratios allow investors to compare performance across sectors and identify consistent, efficient, and well managed companies. Identifying financial red flags is an important part of studying the financial reports. Now let's discuss some warning signs that appear in financial statements. Declining sales or top line or profits bottom line over time indicate slowing demand or poor management. High debt levels can signal that a company is over leveraged and vulnerable to interest rate hikes. Negative or inconsistent cash flows mean the business isn't generating enough real money to sustain operations over a long period. And unusual accounting practices like frequent restatements can be a sign of manipulation of company reports, which may indicate that investors' money is not actually being utilized in an efficient and ethical manner. A disciplined investor pays as much attention to what could go wrong as to what looks good. Investors are risk averse. They would rather have a lower reward than a higher risk. Avoiding bad companies is just as important as finding good ones. To summarize module 2, financial statements form the foundation of all investing decisions. The income statement tells you about performance, the balance sheet tells you about stability, the cash flow statement tells you about reality, or whether profits are actually turning into cash. Together, they allow investors to look beyond the stock prices and see the company's true health or intrinsic value. Understanding these fundamentals is what separates speculators from an intelligent investor. In the next module, we'll move one step further and learn how to use these numbers to determine what a company is really worth, which means we'll look into the intrinsic value and how to find it through valuation and market analysis. See you in the next module. Thank you.